And thanks, Harsha. I would like to call Mr. George. He's going to talk about his experience, his presentations, and I have seen his presentations quite interesting in terms of flow. Thank you. Thank you.
So, hi, good afternoon. I see people interested in this. Let me give you an introduction. My name is Jorge Dyszel, and believe it or not, I've been dealing with commodities for the last 45 years. I am almost 70, and I'm still alive, regardless of the stress of volatility, so this is possible. A couple of things of my past experience. I have the blessings of being nominated in 1981 by a company to create, a company in Switzerland, to create one in South America, which was called Richco Grains, from Mark Rich. And I was the founder of Richco Grain, which became Glencore. And I became the CFO of this company during 11 years. I'm so proud of that. Later on, if you Google me, you're going to find me as a movie maker. Indeed, I am the same because I took a sabbatical, and I spent 2 years directing a film. I was even here in the New Delhi International Film Festival in 2004, red carpet, no volatility, but I couldn't make a living of that. So I came back and I worked another 11 years as the metals trader futures for IUR smelter, and that was my biggest school because I used to trade 3 million tons of aluminum per year, and mostly in options. And later on, I am a consultant, I am a yoga teacher, I'm a lifeguard, and everything helps. And also I work as one of the LME, London Metal Exchange trainers. I am responsible for all the Portuguese and Spanish-speaking countries, means Spain, Portugal, and from Mexico to Argentina. That's my history. Let's go to the present. We have been flying with these examples of volatility, which indeed it happens, but let's land. So please fasten your seatbelt and let's try to land. What I mean by land? By land, I mean that even though you buy, wait, and then sell, if the market is a bull market, of course the price is going to be higher. But this is specifically the case for one speculator. It's not the case for a scrap trader. Why is that? Because you can buy physical, but perhaps the price at which you are buying is not fixed because you arranged with your supplier that the QP, the quotational period, could be at his choice somewhen for the next 2 months. So you never know how much will be the price of your purchase. Do you follow me, right? Yes? And then when you sell, it can be the same. So even though you have a bullish trend, you can really lose money. It's, if you don't hedge, which I accept, your profit will be at completely random. On the inventories, it's different because you fix a price, you pay, you sit on the inventories, you finance them, and of course, the markets are helping you a lot. So let's go to the presentation. Trying to bring you a little bit of peace of mind after that. So, can I move this? Where are we now? Next. Okay, let's see the price evolution for the last 3 months that all of you know. Let's go quickly. Next slide, please. Come on. That's aluminum. Aluminum, okay? Next one. Copper. Next one. Nickel. Next one. Lead. Next one. Zinc. Next one. Tin. All of them showing a bull market. But now, let's see something in special. Next one, please. Come on. They look like twin brothers, not alike, boy and girl, twin brothers. What do I mean by twin brothers? Look at the behavior. the behavior is the same. So what's going on here? The fundamentals are completely, exactly the same. The disruptions are the same? Not. Let's go to the next one, please. And this is more impressive. Let's see what happened from the 1st of December until today, okay? They are moving all the same. What's going on here? Here, the markets go the same way because they are not based on fundamentals. They are not based on disruptions. They are not based on real product demand. They are not based on real product production. And now they know. You know how much in all the futures market in the world, the investment funds, the hedging funds, the people who speculate or invest, they take 90 to 95% of the transactions, while just 5% is for us, the real market, consumers and producers. Just 5% of the volume in the futures market is for microeconomics, the real economics, supply demand. The rest is investment. That means that the investment funds are buying everything. And we are in a bull run mainly sustained by the investment funds. What does it mean? That they are all speculators? Perhaps yes. What does it mean? That we should not pay attention to that? No, not at all. This is why we need to take and to pay attention to the market moves and protect ourselves. Let's go to the next one, please. Now, let's see the views on the big boys, of the big boys. Next one, please. Okay, so the World Bank and Goldman Sachs, okay? Don't laugh. Those were their projections for 2026 just 40 days ago. And you can recognize that the price, let's go to the next one, please. As of Friday, the aluminum was 3,130. Now it's doing, let me see. The same, 3,130. It was much higher. Copper, 12,843. It reached almost to 12,900, and so on. But what do I mean by that? That any time while the prices moves, you can be declared by your supplier, let's fix the price. And what would you do? Just sit? What if the prices go down and later on you must fix the price of sale? You're going to lose money, even in a bull market. Next one, please. So, short quiz. Let me ask you. Please help me with everybody try to answer. Honestly, who of you have an insurance protecting the fire of your plant? Please raise your hand. Who of you? Fire. Almost everyone. Let's see the next one, please. Next one. Okay. That looks like the image of your neighborhood fire, not yours. But anyway, at least from the economical point of view, you are protected. Next one, please. Next one. Who has a protection against prices, ups and down? Please. Come on, nobody. BG Metals also, they brought to me, they are blamed, BG Metals. It's quite a lot of difference. Next one, please. That's the results. Okay? And when is a recycler safe? Of course. Let's see the next one. When is safe? to be safe and to avoid price risk, you need to match the timing of the QP of the purchase and the sale. So they are matched, the timing fits one to the other, you have no problem. So you will know your margin, you will be able to predict your results, but in order to do that and not to hedge, you must match all the pricings of purchase and sales. And actually, the ones who have a good volume know that is almost impossible. It's a mess. Next one, please. So the answer of marriage, buying and selling, brings known margins, timing aligned, and predictable results. Next one, please. But what happens, I believe that someone has got divorced so far, at least once. Me, 3. I'm married on the 4th time, forever, hopefully. 70 years old, imagine. So, now, when operations are divorced, volumes or prices do not match, and margins become literally unknown, uncertain. Next one. So risk appears when the divorce is inevitable. They go to the court, and what happens? Let's see. Next one, please. Okay, so this marriage is getting divorced, and the formula to get rid of this divorce is to try to fix the purchase with the sale. And the problem they present in the court is there are different QPs. Also, if you buy in dollars and you sell in rupees, or you buy in yen and you sell in rupees, and you have cross risk, of course, the proposal of my colleague on platforms which allow you to protect the risk is absolutely inevitable. Of course, you can run the risk, but then your business in these times becomes a casino. Next one, please. And the solution, what's the solution? Let's see, the solution is hedge, right? Next one. So what is hedging? What is hedging? Next one, please. Okay. I did that when the copper was 13,259. Hedging brings you the possibility of balance your account. We have no time for us to explain the technicalities of hedging. But the simplest way to explain you what is hedging is simply protection, okay? Simply protection. Imagine that you have an insurance against a fall if you are long of commodity already priced, or against a rise if you're a consumer. Imagine with those prices, if you have to use the metal to be processed and sold in the domestic market, converted into copper cables, will you be able to raise all the time the prices to your customers also? It is difficult. It is possible but difficult. Yeah, particularly when you live in a non-environment. You cannot keep increasing the prices. So on both sides, purchase and sale, hedging, it's inevitable. Or if you don't hedge, which is possible, I'm not here into being a teacher saying you must hedge, hedge is, no. At least you must understand what hedging is. And hedging is a way to protect your money and your economical equation. Next one, please. So, of course, what is hedging for? To protect your margin, the visibility, to live happily like that family. The family went away. There. Yeah. Give me some second. I spent so much time to grade them. Not truth. It was AI. You know, when you use AI, the secret is the script, you know? And the secret is that you need the AI to know you. I've been working with AI for 2.5 years. And if you follow me in LinkedIn, you're going to see those characters already telling what's going on in a different way. Next one, please. So hedging tools, simple. Hedging with futures, hedging with options. To make the long story short, if you hedge with futures, you close the equation. You know precisely how much money you're going to make for the difference between the net price of sale and the net price of purchase. If you hedge with option, it's completely different. Buying options to the hedger is the opposite compared to the options buying by a speculator. It's exactly the opposite. You buy the options and you pay money, and the volatility you've seen is so high that the premium is dramatically high. But instead of doing futures, you buy options when you expect the market to play in your favor and never exercise them. You just buy the options for protection. It's exactly the opposite logic of a speculator buying options. Next one, please. So here's funny. Where and through whom? Where, I mean, you have the main markets, LME, COMEX, and Shanghai. The next one, please. And through a broker, okay? The broker is the one who gives you the golden key to access to the futures markets to hedge. And here's the thing. Never monogamy. Do you hear me well? Never monogamy. Polygamy. What do I mean by that? You have to have more than one. Why is that? Because you are going to have more pricing options. Second, you're going to have more credit line options, because you shouldn't forget that when you trade in any market, even speculating or hedging, you need to guarantee your transaction. You need to leave some monies as initial margin and later on variation. Forget about the technicalities. You need to guarantee your transaction. And for that, you need a number of brokers who give you credit lines not to sacrifice your own cash, okay? At the moment of time, perhaps you're going to need to put variation margins depending on your position, but polygamy is the answer. Next one. I'm joking, right? So, in a big storm, who stays dry? The fastest or the one who understands and manages the risk? Next one. Your choice. So let's follow with the next one, please, to finish. So now the question is, to hedge or not to hedge? That is the question. Remember that the clouds do not pay attention of what the meteorologists say. They just behave. The same in the markets. What I can give my opinion on the market does not care. The market plays as a human, but is the addition of all the humans acting in that. So we can have, of course, views, but you rather think seriously whether to hedge or not to hedge. That is the question. Thank you.